A very good morning to everyone. Thank you all for being here early in the morning. So we have a fantastic conference for the day. I want to thank all of you who have come here, especially several of our speakers have actually come from abroad. Some of them are not here yet, but the chair of our first session, Tarun is coming from India as well. Thanks to him, thanks to Encasing, who is not here yet. We'll later on, somewhere, we'll also have Mr. Arun Puri here. He is the founder of the India Today Empire. I am Arvind Panagaria, the director of Raj Center, on leave. I'm currently also serving as the chair of the 16th Finance Commission in India with Prime Minister Modi. So we will, as planned, start the first session at 9:30, so in 1 minute. May I request Tarun, Poonam. Poonam has also flown in from India. And we have the Chief Economic Advisor of India, Anantha Nageswaran, who has also flown in from India. So you have really speakers coming from far away. And then we have Ruchir Agarwal, who is also a panelist in the session, and he has flown from much more nearby. So please, all three of you, if you would come in, and we will start the session.
Morning, everybody. Welcome. I'm just going to use the podium because I think each of us will really for making presentations. And good to be here for this opening session with three great speakers. Dr. Anantha Nageswaran, Chief Economic Advisor to the government. Dr. Poonam Gupta, Director General of the National Council for Applied Economic Research, and Ruchir Agarwal from Harvard. All three with great backgrounds, great experience, and I think you'll find them both, all of them, very exciting to start this conference. I have a moment of nostalgia coming back to Columbia. My daughter Rima did 2 graduate degrees here over the years. So I was hanging around the campus in a different capacity as a father, not as a student and not as a CII person, though I was at that time very much in CII. So, Professor Panagaria, thank you for giving me this opportunity to come back. And also to Mr. Deepak Raj and my friend, of course, Mr. Encasing, who will no doubt make a royal entry in due course. I have very brief points to make because I don't want to preempt the three great speakers. My first point is that India is an exciting place to be in. Now, it's been for a while an exciting place. It wasn't an exciting place for a very long time because we were struggling to get economic reforms going and reforms across many, many sectors. But that's been happening. And I think the excitement level is likely to increase in the months and years ahead. This is the way I see it. This is the way I feel with my decades of experience. And India really is a unique development and growth story. It's uniquely Indian. You can't compare it with any other country. It has complexities, challenges of every kind, and we are dealing with them in our own way. And as we are, when there are 2 Indians, there are 3 opinions, and when there are 2 Bengalis like me, then there are 4 opinions. So, you have to take it as, like that, and we sometimes slow each other down in the process. My next point is that a plethora of initiatives have been taken. Really a plethora of initiatives across technology, digital, industry, manufacturing, agriculture. Some have worked very well, some are not worked so well, but they're all ongoing. And there is a persistence, there is a determination and a patience to keep going. So we are seeing, for me, a new India in the making, a new environment in the making, and a new confidence which we didn't have. For many, many years, we were scared of the world. And that sometimes reflects on our trade policy about which Professor Panagre had written so much in the past. But I think that fear and that apprehension has gone. We are engaged with the world. And we feel confident that we will be able to resolve our issues in our own way. Somebody who will come in and speak in the next session is Mr. Dinesh. He's the president of the Confederation of Indian Industry, chairman and CEO of a major corporate. And when you hear him, you will see a symbol of a new India, because this is an industry which is confident about itself and confident about its ability to deal with the world. My last point, apart from everything else, we have reached out to the world over the last 5-10 years incredibly strongly on multiple fronts. And this foreign policy, whether it's the G20 summit or a whole host of other initiatives on the foreign policy side, have brought India new respect and new trust. And I think I will leave it at that, and I will ask now our first speaker, Dr. Poonam Gupta, outstanding economist, great background, great experience, to take the floor. Also fitting that a lady should start. But that credit should go to the chairman of the conference, not to me. And Poonam, the floor is yours.
Okay. Thank you very much, Professor Panagaria, Mr. Deepak Raj, for inviting me one more time to this conference. It has been a pleasure every time to be able to present my views here, as well as to hear from others. This time, the guidance given to me was that I should present on the macroeconomy, might as well. These are interesting times as far as the macro goes. And I have chosen a few topics to talk about. One is economic growth, a number that gets a lot of passionate commentary on each side. I'll just show a few things about the numbers themselves and its composition. But most of my presentation would be about the resilience of the Indian economy. Why is it that when the world is not necessarily doing great, or many other countries are not doing very well, why is it that I think the Indian economy continues to do well, and what explains this resilience? Given that it's a presentation on the macroeconomy, I'll discuss a little bit about macroeconomic stability. As we have seen from around the world, unless growth is accompanied by macroeconomic stability, it may not last for very long. And in India, we have an economy which is growing well. We have an economy which is resilient, and we also have an economy which has achieved macroeconomic stability. And I'll end the presentation with a few suggestions, very narrowly focused again on the macroeconomic aspects of economic policy. So first on the growth numbers, it's one thing to talk about annual growth rates and how they are high. They are 7.6% for the year we just completed, 23-24, are projected to be close to 7% for the year that we have just started, 24-25. But how do the growth numbers look over a relatively long period of time? So here what I have is the decadal average of growth rates, of GDP growth rates, and in which I single out 3 years around COVID, and I call them an aberration. So if you take out those 3 years around COVID and you look at the growth rates over each decade since 1990, you see that GDP growth has been accelerating over time. which is quite remarkable in itself. But when you combine it with the fact that population growth rate during this period has really slowed down quite rapidly, what you see is a faster acceleration in per capita income, which I think is a fact we don't talk about often, but is even more remarkable than the GDP growth rate and its acceleration, which means that well-being is improving in India, and the pace of that well-being improvement is accelerating over time. Questions are raised every time GDP growth data comes out, that it's either over-projecting or under-recording the true growth rate of the economy. So at NCR, as a part of our macro work, as do many other market analysts, we track high-frequency indicators. These are the variables that have started to now become available at a monthly frequency, some of them at weekly frequency, and handful at quarterly frequency, which is that you try to make sense of these high-frequency indicators to see whether they are consistent with the growth numbers that you're getting from the national account statistics, be at quarterly frequency or at annual frequency. And for the past couple of years, I've started to put them into two columns. The variables which are showing overall buoyancy and variables which are not showing buoyancy and either are giving mixed signals or are weakening. And interestingly, and this has helped me really make a sense of how the economy is evolving quite well, the variables that I put under this column of overall buoyancy, the list is very large, and it remains to be large. It includes variables such as tax collection, credit growth, services exports, PMI indicators of services and manufacturing, mobility indicators, digital payments, and so on. When it comes to weaknesses, the variables here are not surprising. India has been perhaps underperforming in the exports of goods, not in exports of services, but in exports of goods. FDI inflows have softened recently. And when it comes to either the employment numbers, but more than that, the quality of employment, I call it mixed indicators. And I was talking to the CA Anantha that any questions on employment he will field in the Q&A. One more concern we hear in India is that growth is not very well balanced. Either we hear that consumption is contributing a lot to growth, or we hear that consumption is contributing very little to growth. And as a part of a larger analysis, I'm just giving some glimpses of that. We look at the share of consumption in GDP as we look at the shares of government expenditure, investment, exports, and imports. So two things stand out. First is the relative shares in GDP over time. Share of consumption in GDP has declined in India and is currently at about 55%. Share of investment, on the other hand, has increased from about 20% in the 1990s to about 34% currently. Those of us who track the Indian economy a little bit regularly and intensely, we know that there was a decade when this ratio did not budge. It was just flat, but it has started to revive now. On the other hand, government expenditure to GDP ratio has remained broadly stagnant. If you compare it with other countries, India does not have a very large government at all, at about 10% of GDP. Share of exports in GDP has increased, more than doubled, almost tripled, as has the share of imports. So this is just to look at the numbers to make sense of whether the ratio of consumption in GDP is very large in India. When we compare with other countries, it's similar to that of other countries, where India actually has a smaller share, that is of government expenditure as well as exports. But for consumption and investment, it's comparable to that of other countries. Now, that much about growth. Let's move to increased resilience of growth. Why is it that India is continuing to grow at 7 to 7.5% despite the fact the world is not looking as strong? And here is when I started thinking about it, these days I write a monthly column in Economic Times. It ended up being an 800-word op-ed to explain increased resilience of the Indian economy. And I came up with 5 factors which now matter less, 5 shocks which now matter less for the Indian economy, resulting in its improved resilience. First is political or policy uncertainty. Elections after elections, we have decisive mandates. Governments fulfill their entire term, which is resulting in more policy certainty. Besides the fact that successive governments are not reversing policies of the previous government, so there is, in some sense, a definite direction in which the policy reforms are going. Another one is the increase in the price of oil has become less of a story for India over time. And what is the reason for that? As for the other countries, oil intensity of GDP in India has declined. For every $1,000 worth of GDP, Indian economy now uses less oil, which means that even if oil prices increase, as they have recently, to about $90 a barrel, it does not impact the growth rate of the Indian economy, or for that matter, many other things, such as current account deficit, etc. And in fact, if we just plot oil prices against oil deficit on the current account, there is a bit of a disconnect in them. So, this particular terms of trade shock now matters less for India, which explains its continued tendency to grow at 7 to 7.5%. And this trend is likely to continue for a number of reasons, including the move towards renewables and increased efficiency of energy. Another factor is that rainfall, which used to be at times a mega macro story, is no longer the case. Deficient or erratic rainfalls do not impact agricultural growth rate to the same extent as they used to earlier. On the right-hand side is a panel, is a chart in which I'm plotting year-over-year change in rainfall with agricultural growth rate. And we can see that agricultural growth rates have stabilized. Now, so here we are looking at decadal averages of agricultural growth rate, but also the standard deviations of annual growth rates during each decade starting in 1990, and the range of maximum and minimum growth rate during each decade. And as we can see on multiple indicators of volatility, agricultural growth rate has stabilized more than in the past. Besides the fact that agriculture is now a smaller part of India's GDP, even if growth rates are impacted during a certain year, they do not impact the overall GDP growth rate to the same extent as they used to early on. Now I'll jump to the macroeconomic stability part, including how the financial sector is doing. When we talk about macroeconomic stability, we talk about a few different variables, and it's very much what the IMF does. IMF, just as a general practitioner, looks at these variables when it has to pass a quick assessment of any economy, which is current account deficit, inflation, financial sector, balance of payments, forex reserves, and public debt and deficit. So how is India doing on each one of them? Current account deficit is low, at 1 to 1.5% of GDP. This level is considered eminently sustainable. In fact, any level of current account deficit up to 3% is considered to be safe. Inflation is range-bound and has become less erratic since India adopted the inflation targeting a few years ago. Financial sector has been cleaned up. Non-performing loans are low and credit growth rate is very, very high. And BOP and forex situation is very comfortable as well. So let's just look at some of the data on each of these variables. As I said here, we are comparing India's current account deficit with the average of other emerging markets. So India is in black. So current account deficit to GDP ratio, this number may even get revised upwards soon, is less than 2% as compared to an average of emerging market, which is 3.5%. And as I said, 3% usually is considered to be a safe level. And we can compare with some of the usual suspects that we like to compare India with, which is large emerging markets. and India's current account deficit is on the lower side. Inflation is even a more interesting and striking story. There were years when India's inflation was higher than that of the global average or the average of other emerging markets. And here now we are in a situation when India's inflation actually is below that of the global average or that of other emerging markets. And if we look at this variable carefully using high frequency data, we can also see some stability. You know, the days of very high and very low inflation seem to be over, and you have inflation which is rather range bound. It's higher than the 4% inflation target that the country has, but still very, very range bound. Credit growth, after nearly a lost decade as far as India's banking sector is concerned, has started to revive. It's currently nearly 20% of very, very healthy level of credit growth. And this credit growth is seen across sectors, be it personal loans, agriculture, or services. Manufacturing is the sector which does not show a very high growth in credit. So there is a consistent narrative there that manufacturing sector perhaps is underperforming, as has been the case for many, many decades. Non-performing assets across banks has declined. The fact remains, though, that private sector banks have better indicators when it comes to the profitability or efficiency or health of their balance sheets as compared to the public sector banks, despite some recent improvement that we are seeing. And this is what we have on this chart. Overall, on balance of payments, we have already talked about current account. As far as the capital account goes, it has two main components. One is portfolio flows, which are considered to be fickle, very, very volatile. And they were volatile for India as well for a good 1.5 years after the Ukraine war had broken out. But they have resumed in recent months. Fickleness of portfolio flows remains an issue for all emerging markets, including for India. But India has learned to address that challenge better. I won't have the time as a part of my presentation to go over it, but basically, based on the kind of communication that goes out from both from the government and the Reserve Bank of India, prudent use of foreign reserves, swap lines, etc., means that the country is able to address the volatility associated with portfolio flows better than in the past. FDI flows, however, have softened, so it's very much a work in progress. Capital inflows have been quite sufficient to finance India's modest current account deficit, so much so that reserves have been replenished. They are at $650 billion currently, which is considered a very safe level. In fact, US monetary policy has started to matter less for India. As I said, it does impact flows of capital, it does impact risk aversion and can have implications for exchange rate, etc. But because of the response of the RBI and the government, which has matured over time, there is now these issues and these episodes can be addressed better, which is reflected now in a disconnect between the bond yields of India and the US. As we can see on this chart, here, well, we have shifted the color. Red one is India, black one is US. And it's reflected, among other things, also in how the Indian equity markets are outperforming the markets in other countries. So, elephant in the room, given that Mr. Singh is here, fiscal deficit and public debt. One does not have a story as happy as that. It's a little bit of a mixed narrative. India's public debt is very, very high compared to any other emerging market. At early 80s as percentage of GDP, it's among the highest. It increased during COVID, and since then it has declined from the COVID highs, but has not reverted to the pre-COVID levels and is unlikely to revert to pre-COVID levels anytime soon. In some work that we have done at NCER, we have looked at fiscal outcomes over a long period of time, 30 to 40 years. And what we have realized is that fiscal outcomes are sticky. Revenues do not increase rapidly, even during a decade. Expenditures are, a large part of them are committed expenditures, and so on. Despite the fact there has been a recent shift towards capital expenditure, fiscal outcomes remain sticky. Similar level of debt in other countries would have resulted in debt distress, but that has not been the case in India, and that's because of the way its debt is financed and managed. Most of the debt is long-term. It's in local currency. It's held domestically. It's held by institutional investors. Most of them are fully or partially owned by the government. It's on fixed rates. So the reason why India has been able to manage its public debt without there being any kind of distress, market reaction, or response in bond yields is for two reasons. One is capital controls, that all these institutional investors can only invest in government securities as a safe asset, and adequate household savings rate, who are happy to channel indirectly their savings into government bonds. And the last part may change over time. I still have just 2 minutes left. But this level of high and elevated debt should be of worry, because it just means that there's a whole lot of amount being spent of interest payments, even if it has not resulted in a financial distress. 5% of GDP in interest payments is very high. It means that there is less left to be spent on education and health. Domestic savings, household domestic savings have been declining, and financing this debt can become more difficult going forward than was the case in the past. So to sum up, I'm right on time. So growth outlook is optimistic. High frequency indicators corroborate that. The economy has become more resilient to the shocks, which means the future is brighter than has been the case. Macroeconomic stability has been won the hard way, and it ought to be maintained, and it's likely to be maintained, which means inflation, public debt, current account deficit, etc. There should not be any temptation to compromise macroeconomic stability for short-term growth. Just a couple of more things. Monetary policy framework has matured. India has been in inflation targeting for close to 8 years. It may need to be gently updated at some point, and I think 8-year mark would be the right thing to do. As I said, inflation is above the target but within range, and a couple of things can be considered. One is playing with the range and level of inflation, but more importantly, upgrading the inflation basket to more accurately reflect on the real composition of expenditure. Financial sector stability is great. I think going forward, the regulator may have to step up its efforts to better balance the competing objectives of growth and safety. Right now, there seems to be a bit more of risk aversion, but I think the two competing objectives need a better balancing. Fiscal rules and frameworks are completely off track, and Mr. Singh is here, who knows better about these issues than any of us, and this is something that we need to look into. Thank you.
Good morning, ladies and gentlemen. My sincere thanks to Professor Arvind Panagaria for inviting me to share my thoughts with you. I think Poonam has done an excellent job of setting the stage and the context for my remarks. I'll probably start with the slide where she showed the high-frequency indicators. The left side was a pretty long list of things that are going in India's favor. And the right side had 3 bullet points. One was growth, and one was FDI flows, and the other one was employment, and also the quality of employment. And of course, she said all questions related to employment would be addressed to me. But in order to preempt some of them, I'll try to make some initial remarks. In her initial remarks on the growth numbers, the 3 years between 20 21 until 22-23, average 3.6% because we had a contraction in 2021 in real GDP. And the current, the financial year that just ended probably will be between 7.5 and 8. So, but what preceded the COVID years, where the average growth rate in that period was 3.6? We should remember. And I want to take you even further back, not just the years preceding COVID, the second decade of the millennium, but even further back. In general, if you look at the BIS data, India's bank assets as a percentage of GDP between 1980s and 1990s averaged around 25 to 30% of GDP. It was just in this range for 20 years. And suddenly, after the new millennium, given the high growth rates, sense of optimism about BRICS, which was coined in 2002, if I'm not mistaken, and the expectation that India would follow in the footsteps of China in terms of achieving high growth rates, bank assets exploded. And you must remember that that was the decade in which nominal GDP growth averaged 12 to 14%. So when the nominal GDP growth was in double digits, you had the bank asset to GDP ratio double to between 55 and 60% of GDP in just one decade. So when a ratio doubles, when the denominator is growing at the rate of 14 to 15%, you can imagine the growth rates in bank assets in India. Naturally, or unsurprisingly, we had a non-performing asset crisis when growth rates ebbed and peaked and then found it difficult to recapture the old highs after the global financial crisis of 2008. The government's fiscal policy and monetary policy both were accommodative, probably longer than they should have been after 2008-9. And that did keep growth rates going until 2011-12, but that couldn't be sustained, and we were part of the fragile five in 2013, and the rupee collapsed. Both inflation was in double digits for 5 years, ending 2014. Current account deficit was around 5% of GDP, etc. And naturally, the risk aversion, both in the banking sector and in the corporate sector, meant that both demand for and supply of bank credit slowed down quite considerably in the second decade. And also, after global growth rates peaked and were struggling to regain their momentum despite quantitative easing and zero interest rates, India's export growth, which was a big contributor to GDP growth in the first decade, could not achieve the same momentum in the second decade. So basically, even before COVID happened, India was battling this non-performing asset problem and risk aversion in the corporate sector and in the banking sector, which led to the investment rates going down. And then, barely had India addressed this issue, there was a non-banking financial institution that collapsed in 2018, September, October, infrastructure leasing and financial services. And the government came back to office in 2019, and then by February of 2020, we had the pandemic. In other words, we had successive shocks. And then as COVID ebbed, then we had the war in Ukraine, commodity price shock, and a sudden and swift increase in interest rates in hard currencies in 2022. If you leave out these external shocks, internally at least, India was basically, since 2013-14 onwards, was grappling with the fallout of an excessive credit growth, a credit boom followed by a bust, and the pandemic, etc. So when we look at the employment performance of the Indian economy, we need to keep this fact in mind that India had weathered two successive shocks of very high proportion, very high magnitude and impact. So now, having said this context, let me address how the employment creation fared. As any economy transiting from a low income status to lower middle income status, agricultural employment in India was going down at the rate of 1.6% per annum between 2004 and 14. And in fact, between 2014 and 19, this contraction actually accelerated to 1.7% per annum. As you would expect, as workers transit from the primary sector to secondary and tertiary. What made it difficult was this absorption of surplus agricultural labor into the other sectors. What was challenging was the manufacturing sector, because of the problem I described earlier about the credit boom and bust. Manufacturing actually did not create jobs between 2014 and 19. On a net basis, actually, it was losing jobs. Then during the pandemic, 40 million people migrated back to rural India in 1920 and 2021. So naturally, two things happened. The flow of income from urban India to rural India came down, and excess supply of labor in rural India naturally meant rural wages also got depressed, which is why the government extended the free food program all the way until 2026, because when shocks happen, they do take their own time to actually dissipate. Whereas the impact of the shock is fairly quick, their dissipation is longer. And the good news is that in 21-22, which is the year after COVID, manufacturing sector has begun to create jobs. It created 3.7 million jobs in 21-22. I'm using all these numbers from the RBI Capital Labor Energy Productivity CLIMS database, RBI CLIMS database, which gives us annual data for 40 plus years. And the latest one that we have is for 21-22. So manufacturing began to create job, and there is a small reversal, a beginning of reversal of this huge migration that went back to rural India in 1920 and 2021. So that is also beginning to happen. But amidst the cyclical stagnation in the manufacturing sector and now its recovery, the services sector was a bright spot, as Poonam also mentioned. And maybe in the last couple of years, the information technology sector has been struggling to create jobs, but hopefully manufacturing is taking over. So when we assess the employment performance of the Indian economy, between 1980 and 2000, the overall job creation, including agricultural sector, was about 3.3%, and between 2000 and 2022, it was 3.1% per annum. So not much of a change. It is the fact that the second decade was a problematic one for growth and investment that probably explains the slight problems we have faced with respect to the job creation mechanism. But there are signs that the job creation engine is beginning to hum, and it is coming back, both with respect to the restoration of the trend away from agriculture and manufacturing job creation happening. In fact, my friend Dinesh is not yet here, and that is the message which we have for the private sector, because the private sector was so keen on ensuring that balance sheets were in good shape. Naturally, savings and investment balance in the private sector was more positive than negative since has been more positive than negative since 2014. In other words, the private sector wasn't investing as much as it used to, which is for understandable reasons. Otherwise, normally what happens is the household sector saves, the private sector and the public sector are net dissavers after you take into account their capital formation, which hasn't been the case with the private sector for quite some time. In fact, in the last 6 or 7 years, up to the year ending March 2023, 6 out of 7 years, the private sector has run a net saving surplus in India. But it is about time that the private sector obviously steps up its investment game. And I think there are signs of it in the data already, both in 21-22 and 22-23, because this net saving surplus is beginning to shrink, both in percentage terms, as a percentage of GDP, and also in absolute rupee terms as well. So this is the backdrop with which we look ahead to the rest of the decade with a lot of optimism, which is that the investment cycle, which was a prominent feature of India's growth in the first decade, is actually coming back with repaired balance sheets and so on. And this naturally will have its own virtuous cycle, given its positive spin-off effects on employment generation, income growth, etc. In the remaining 3 minutes, I also want to address one more issue that is currently being discussed in the media, is the Indian household sector facing some sort of financial stress? The answer is no. There may be pockets of stress, which is why the Reserve Bank of India tightened prudentially the risk weights for unsecured personal loans. But that is not the only story. In fact, if anything, that could be a marginal story. If you look at the data on household savings, more than the decline in their financial savings in the last 3 years, the savings in real assets has increased a lot more. In other words, households have been very prudently reallocating from financial to physical assets, given the fact that the second decade of the millennium in India saw real estate prices stagnate and even come down in several cities. So it's a very sensible portfolio shift. That said, so between financial and real assets, there has been a shift towards real assets in the last 3 years, much more than the decline in financial assets of households. But that said, the overall household savings as a percentage of gross savings is lower by 4 percentage points in the last 3 years, exactly matching the 4 percentage point increase in the net financial savings of the private sector, private corporate sector. And in that sense, that is why you don't see this impact in the current account deficit, because it is within the system. Basically, the fact that households are accumulating real assets means the private sector basically gives them mortgages, and that is a demand for construction items and goods, steel, cement, etc. So whatever is the private household sector saving in physical assets, it is reflected in the saving surplus of the private sector. So from a macro perspective, this is not an imbalance for us to worry about. As far as the household sector is concerned, there are multiple reasons why household loan growth or personal loan growth is growing quite vigorously, is quite vigorous. A lot of people who are hitherto financially excluded are now financially included. And they are able to secure loans without posting any collateral because of the digital footprints that they're able to leave behind. And banks and non-banks are able to tap into this and lend. And this is the initial phase. This will settle down over time. And second, households are also now acquiring durable assets more than they are spending on non-durable assets, even in rural India. Yes, of course. So yeah, I'm done with my 15 minutes. I'll conclude. And also, there is some case where households are now beginning to borrow and invest in the financial market, in some of them for speculative purposes, and that is something which the central bank and the capital markets regulator are aware of, and that is the reason why the unsecured lending loan weights went up under RBI's guideline November, December last year. So net-net, since Poonam gave a good picture overview of the overall positive story, there were a couple of concerned areas that she highlighted, and I thought I would devote my remarks to addressing them. One is the employment situation, and the second is the private sector's reluctance, so-called reluctance to invest, and the third is whether the household sector is facing any distress or not. I will take your questions later when we are open for Q&A. Thank you very much.
So I also have about 15 minutes, and thank you to Professor Panagaria for inviting me, and it's great to see a lot of you part of this conversation, including Mr. John Lipsky, Mr. N.K. Singh, and a lot of younger faces. So what I'm going to do today in my 15 minutes is talk about three things. I'm going to talk about what I call the anti-puzzle of Indian growth. I'm going to talk about three trends to watch, at least that I'm watching in the near term, and then three growth challenges in the medium term. And I'm very glad to go right after Anantha and Poonam, because a lot of I'm very encouraged to see that our reading for several things are quite aligned in the story, the way we are telling the story in our minds at least. So first is what I call the anti-puzzle. There are a lot of commentators, even 2 days ago, there was an article in The Economist arguing, raising doubts on India's growth numbers. I used to work on the Indian desk at the IMF, and I've looked at the Indian national accounts very closely, and I'm going to give you some thoughts on that right now. So basically, it appears that India is at the start of an upswing. The growth rate in real GDP growth in the last quarter of 2023 was 8.4%, and some people saw this and say, how could it be? It seems too high. And what I'm going to say is actually the puzzle is the exact opposite. I think it's too low, and I'm going to show you why. Here is basically the red line is basically what the India's pre-pandemic growth trajectory was. India was growing roughly about 7.1% in the decade 2012 to 2019, and then it was hit exactly as Anantha put it, with successive shocks. Okay, and so what I'm going to show you just in the next chart is just the gap between this red and blue lines, which is here. Okay, so the three shocks, as I see it, very aligned with Anantha's story, is the first, what I call, also in a new book, the financial crisis of 2018-20. I think this is a really important period for all of us to study. And actually, Anantha has a background in finance, so he's brought that kind of perspective into the macroeconomic thinking. And I think in India, finance story is a really important one. So that shock already hit India before COVID began. Now, then the first COVID shock, and then the Delta wave shock. But if you compare, now, if you say, suppose India should have kept growing at 7%, if these shocks had not happened, where India's GDP is today, we have a gap of about 15%. Okay, now, maybe that you say that counterfactual is not correct, but suppose you take that counterfactual, there should be already some arithmetic of catch-up. As Anantha said, people coming back from the rural areas into the urban areas, a lot of investment picking, which I'll show you in a second. So we should not be we should be a bit more clever and go back to high school, middle school arithmetic and not see 8.4% just as a growth rate, but say, what does that mean from a GDP level perspective? And now you may say, okay, but maybe other countries have the same gap. What I'm going to show you here is India is actually an outlier among all global major economies. So here I just took the IMF's projections just before the pandemic and the projections now. And what you see is India on the top left, that gap, the 15, 20%, in their numbers about a little over 15%, that remains in India, whereas US is where the gap is completely closed. China had closed the gap, but then it opened up again because of later shock. Now, is this something unique about India? No. In fact, if you go back to the global financial crisis, the exact opposite had happened. The US had a big, persistent negative shock, and it was a long-lasting shock, whereas India recovered quite quickly. So one version of this could be something we should look into. Maybe there's something about finance that leaves very long-lasting impact that may be at play here with, as Anantha was saying, with the successive shocks at play. So that's why I think the puzzle should be, why isn't growth rate higher? We should not just look at just the absolute numbers, but we should look at what the potential of the Indian economy is and where India is currently. Now, moving to my second part of the talk on the three trends I'm watching in the near term. I'm going a bit fast, but mostly to be respectful of the time. Here, Poonam already talked about this, but I just wanted to give you a historical, a bit longer perspective on investment rates in India, which we macroeconomists call gross fixed capital formation as a percent of GDP. there's three phases. From 1970s till, few decades, it was roughly 20%. And then there was a rapid, steady increase. Also, Poonam talked about this, all the way up to early 2010s, okay? And there's much talked about is the fall in investments, right? So give you a reference point, middle income and low income countries, investment to GDP ratio is about 34%. So India is currently is at 34%, so right at that level. And much has been discussed about why that fall has happened and but I want to focus really, what's really remarkable is within a couple of years, that share has gone up by 3.5 percentage points, okay? And in the popular press or imagination, first, I don't think many people have internalized yet that uptick. But those who have internalized that, they tell themselves the story that largely is government spending driven, but actually most of that is coming from the dwellings, like buildings. It's really an urbanization, construction, housing, and partly roads and other story. And so I think this decline was also that story, as Anantha said. And this is something very much to be watched and to be understood, because a lot of India's growth story depends on that urbanization story. So that's one trend to watch. And then the second trend to watch, there's a chart also, a version of this was also in Poonam's presentation, but I want to put a little bit more, I want to spend a bit more of my 15 minutes on this, because I do think this is crucial to the story of India. And the country has been hit with a financial shock that has its origins in a lot of sins in lending, from the infrastructure lending, say, all the way back to the early 2000s. But it came to pass in the banking sector first in the mid-2000s, when there was what we call the annual asset quality review, AQR, and then that shifted into the non-bank sector. And so I have a new book on this, which basically tells the story. But what's really interesting is, with the repair happened and repair is complete in the financial sector, there is large recovery in lending, as Poonam showed in one of these charts, left panel she showed. And this is something really interesting and to watch. And I really loved how Poonam framed it. There is a trade-off between growth and safety. And I actually agree with Poonam very much that I do think that the authorities may be erring too much on the safety side, especially when you take the macro implications of being too prudent in banking when a large fraction of the country remains unbanked, okay? The 2B of the trend that I am watching, and I think this is probably the most exciting trend in India from my perspective, is India Stack, or digital lending. There are a lot of people who have been very excited about the digital payments in India. I personally don't think that has such a large welfare benefit. Transacting with digitally versus cash does not necessarily, I think, have such a large change in your welfare. But what does change is when you can get lending. You can be brought into the lending system where you've not been able to be banked before. There were no people around your village or tier 3 city willing to lend you, but today you can open your app and get lending. This is a game changer. And already about 15% of total disbursements are happening digitally, with 4 or 5 years ago it was 0%. And imagine a person born in a village in Bihar today who had basically near zero chance of being connected to the formal credit system, now having that link. And so a lot of the lending there are many more loans, because the size of these digital loans are really small, and is being led by the NBFCs, the non-banks, which I think are critical for Indian growth. And this is a space really to watch. And that's where I want to go back to Poonam's point, that getting that balance right to allow them to take some risks, even if there will be some losses. And we have to keep our trauma of the 2010s of the banking sector a bit at bay to still allow that growth to happen, because I think a lot of India's growth story will depend on that. The last trend that I'm watching in the near term is what's happening in the business formation, also links to what Anantha was saying. Here, I just did a kind of a Halti-Wanger style analysis, like what is the monthly rate of new business being created in India? okay? And the way to read this graph is like 100 is kind of the somewhere in 2017, right? So that's like the number. Every month, about 17,000 businesses are being created in India now. And so there's been a jump post-pandemic of about 25-30% in the business formation rate. Now, I've been looking, so I downloaded like 20 of these companies. I've been looking at what they're doing and if I can find anything about them. There are very interesting, like people who were before doing tutoring, they are now forming companies to do education, tutoring, and they're formalized. Or people who are doing nursing services have small nursing shops. And so this is a trend not just happening in India, it's happening around the world. Here's a chart from the US, where you've seen basically very similar chart, where you see a big jump of 30% or so of business formation. And I think this is really exciting because that's the gift of the good upside of the pandemic has been to bring a lot more formalization. And this is something we should keep an eye on. Okay, now, the three challenges, as I see, this is my unconventional part of the talk, where I'm looking ahead. In the fall here, I had given a talk on why Bihar and Uttar Pradesh are key to India's growth story. And I'm going to link it slightly to that theme again. There's a chart I had shown last time, which I'm recreating here. It's a chart of income in India across states, okay? And the yellow is Uttar Pradesh and Bihar. Those if you know India, 1 in 4 people in India live in those two states, okay? So 25% of Indian population living in those two states. But their income is roughly about $750 per year annual income per capita. It's roughly 4 or 5 times lower than many of their peer states, okay? So India's growth story is very much intimately linked to the story of how Bihar and Uttar Pradesh or states like that will evolve. And the fundamental challenge for us is, and the reason is, by the way, because a lot of the growth will happen from convergence, with the poorer parts becoming like the richer parts, right? And so the fundamental question, and this goes back to what Anantha was saying, do we move opportunities to the people or do we move people to the opportunities? And that's where things like digital lending becomes really interesting. That's where things like migration that's where the creation of new tier 2, tier 3 cities become really interesting. So the 3 challenges from this perspective, I call them 3 missings, okay? The first is the missing metros. So here, there are various ways to show this. What I did here was I went and got the data on city sizes in the year 1900 and the year 2011, which is the latest census, and I just plotted them, okay? Now, in many countries, when you do this, the slope of this is much lower. What does that mean? Smaller cities should grow much faster, and so you don't end up with the same few number of very large cities 100 years later. And most of these large cities are actually British cities. Delhi grew really fast compared to Kolkata, where I was born, because in 1911, the capital shifted. And so you can see that policies matter. But here, I want to show you, like, many of the cities of Bihar and Uttar Pradesh are in that black box there. And they basically have not grown as much. We would want that box to move up to basically facilitate urbanization locally in those states. The other problem, as I see it, is we would like to see more cities in that second black box, right? That's what my dream is, to have more tier 2, tier 3 cities. Why does this matter? Today, a big constraint for a lot of people, imagine you are a worker thinking to go back, as the worker Anantha is talking about, the 40 million who went back to the village, to come back to the city. A big cost is cost of living, rental, price of land. And that's a big problem we're facing in larger metropolitan cities. So the way tier 2, tier cities can come to play is where cost of land is cheaper. So if we can get more financing and more infrastructure investment, more connectivity to these cities, in my view, that's God's work. And also God's work, I would say, is zoning in the tier 1 cities to improve the labor supply problems, which Dr. Panagaria has talked about as well. Okay. Now, the second thing that I think is the missing banks problem. Okay, so this chart is showing data that come from Civil TransUnion from 2022. There are about 800 million adults in India. Only Until 2 years ago, around 2000, only 180 million of them were served adequately with credit, had access to credit. About 50% today have no access to credit, 50% of Indian adults, and 20% are underserved, which means they have basically one account which is practically not active. So 70% of India, that's the opportunity that awaits us, right? Now, does anybody know here how many banks there are in India? Who said that? If you exclude the foreign banks, about 90, right? So there are about 34 commercial banks in India and about 55 small regional rural banks, like milk cooperatives and stuff. That's roughly the number of banks that you have in Spain with a population of 47 million or Malaysia with a population of 33 million. That's what I mean by conservatism, okay? What's happened in the India story, that's where the non-banks have played a very important role. Non-banks are banks which are basically don't have one arm. What arm they don't have, they cannot get deposits. But these banks, non-banks have very strong legs. They are going where traditional banks will not go. They will go and lend to used truck, people who are doing used truck businesses, they will use that as collateral. They will go to the villages, cities, tier 3 cities and do lending, but they're also very risky. And those are exactly the type of entities that got us into trouble in the 2010s. So now the story is, can we play it right without being too conservative by empowering them and helping some of them become real banks to get their own deposits? So a big part of my book also talks about this thing, which I call the India's great funding imbalance. I don't have enough time to fully tell the story, but a 30-second version of it is, on the bottom right-hand side here are the non-banks, okay? And then you have the private banks, and then you have the public sector banks and mutual funds and insurance funds. This is the net exposure, okay, in percent of GDP. So non-banks have about 12% net borrowing from these other institutions. Either these banks are lending to these non-banks or they're going to the money market and basically borrowing through the CD market or money market mutual funds. And so that basically increases the cost of borrowing for all these people that the NBFCs are serving. So my dream is we interrupt that problem and help these non-banks to directly raise deposits in a cheap way like the public sector banks are doing. That's why I call it God's work, because that's where you can directly lower the cost of borrowing for the majority of Indians who are living outside the tier 1 cities. The last thing, which I call the missing billion, is here I did a little bit something fun. I looked at India's rich list, the latest rich list from Hurun, and there are about 1,300 people in India with net wealth of 100 billion rupees or more, so that's about $120 million or more. And I just ranked by people by surnames. The first one are my people, the Agarwals. And actually, I have to admit, all my family, everyone does business except me. So at least I can talk about them doing business. 82 of these 1,300 are Agarwals, right? About 6%. And many of the other names here are also Agarwals, like Bansals and all, but they don't use the word Agarwal. So we are, a very large percent. Now, this is just a way to make it fun, but I also got the data for about 1.6 million firms that are registered in India and looked at the directors. Okay, 1% of surnames explain 43% of all businesses in India today. Okay, the same story is in with patents. Like 1% of people explain about 60% of patents, and 1% of people explain about half of all publications. This has improved over the past century. It was much worse 50 years ago and is improving, but this is not a story about inequality. This is about excellence. Like India, from an innovation perspective, is working as a country of about 400 million instead of 1.4 billion. But if we can draw from a larger pool of people to come up with frontier ideas, to come up with unicorn companies, to come up with Nobel Prize winning science, then that's not just good for India, that's good for the world. And that's kind of what after I retired from the IMF, I've started 2 nonprofits which focuses on that, which is finding the smartest kids and creating opportunities for them. And then, okay, so that's all I had to share. Just to recap, I talked to you about the anti-puzzle for growth, where I think the real puzzle is, why isn't growth higher? And I think that's the deeper question we all should think about. And I do think that could be a macrofinance linkage story there. Then I talked to you about the 3 trends to watch, which is aligned with what Poonam and Anantha talked about, which is the rise of capital investments, the rise of credit flows and digital lending, which I'm very excited about, the rise of new businesses. These are good things. And then what I think is where we will face headwinds, where we can be proactive, and we need the wisdom and collective work to unblock that barriers, are what I call the 3 missing metros, the missing banks, and the missing billion. So thank you very much.
And very much aligned, very complimentary. Compliments to the chairman of the conference for choosing these 3 outstanding speakers. Before we open the questioning to the floor, the participants, just 1 or 2 questions to the panel from my side. Dr. Nageswaran, you very rightly focused on employment, and I think Poonam was right to pass the buck to you, and you did a great job. There is an explosion, in my view, of self-employment in the country today. Young people don't want to necessarily work for organizations. They want to do their own thing. I see this widespread. And I'm also seeing a new initiative on handmade in India. Crafts, artisans, keeping the traditional family businesses going in the rural areas particularly. You want to comment on this? Is this something which is going to make a difference, or is it too small? Because I don't see the large corporates adding to the employment. I'm associated with 1 or 2, and with automation, with artificial intelligence. We're all generally downsizing. But I see a positive story somewhere else. Am I on the right track?
No, I think you're absolutely right to bring this up. And in a way, when Ruchir spoke about the missing 3 links and also the middle one where he was talking about explosion of startups. So one kind of answers the other. And that is also in line with what you're saying. Because earlier, these entrepreneurial zeal or interest used to be confined to the big metros, but now you take any reasonably good quality engineering or management school in the country, they all have their incubators and startup ecosystem cells, etc. Of course, the problem is in ascertaining whether it has already reached a scale where it is an answer to the employment problem. There I would be a little cautious in saying that it is the answer yet. It is not. And given our size, and I think there is probably everywhere in the world, understandably so, there is fairly little comprehension of what it takes to get a country of this size moving. So we obviously need, therefore, the answer. We need all answers. We need answers from the entrepreneurship side. We need answers from the employment side as well. So I think it is definitely a trend, and we are hearing it with a lot of powerful anecdotes. But I think we need to see this in very significant numbers to say that it has emerged as an answer to the employment challenge.
Thank you so much. Thank you. Poonam, I have a question to you. You made a tremendous start for this session with your presentation. I don't know whether I missed it in your presentations, but so if I did, please accept my apologies. Government expenditure on infrastructure. I'm associated with a major construction equipment multinational as chairman. Has been amazing. It has, and you see it in the country, the transformation of infrastructure. That has led to companies connected with construction doing extremely well, investing more, setting up new factories. This may be just an isolated part of the private sector. But did I get a sense that you were saying that government expenditure, capital expenditure was not doing well, or did I get the wrong signal here? Would you like to comment on this government expenditure and infrastructure?
Right, so let me take this question in a slightly broader sense and also picking on what Ruchir and Anantha said.
Sure.
So there are few facts that are correct about India's public debt. First, it's very high in a cross-country sense. This is what Ruchir said. Second is there has been recent shift towards better expenditure allocation, which is towards capital expenditure. That shift is more evident at the central level than at the states level, right? But the shift has definitely occurred. A third thing is whether this level of public debt, despite the reallocation of expenditure, should it still be of some concern? My view is yes, and that's what I thought I picked up in what Ruchir said. A final point is what Anantha mentioned, that corporate sector has not been investing. It has been a net lender in the last 4-5 years. Household sector has been investing more on the real side, less on the financial side. If you add those two trends with the government's borrowing needs, that means the space is likely to become even tighter going forward, right? If the households are not channeling their savings through the financial markets to be invested by the corporates or government sector, the space, financing space is going to be tighter. But also, as Anantha wishes, if the corporate sector starts investing more, then bond yields will increase. The stress that we are not seeing today will likely happen. Then the question is the household savings rate, how they are being allocated and how they are being intermediated. So this reallocation towards capital expenditure is absolutely great and welcome. It's happening more at the level of the center and some of the states, not all the states. But even so, despite this welcome shift, the financing landscape remains very, very tight and may become tighter going forward.
Thank you so much. That's very good. Ruchir, one question to you. A lot of provocative remarks that you made. You focused on UP and Bihar. Incidentally, there's a lot happening in UP, but I'll not go into that. You left out Bengal. You mentioned that you were born in Calcutta. So was I, by the way. And it's so sad to see the decline of Bengal. Would you not add Bengal to that map of yours? Because whether it's governance, whether it's growth, there's no investment in Bengal. There's nothing happening there. So why did you leave Bengal out?
Yeah, so I wish you were here in the fall, so I gave an answer to that question during that presentation. But basically the short answer is, what I'm looking at is, I'm very interested in knowing what's happening across states in India. And according to my analysis, there are 4 growth clubs in India. And this is true for last 50 years or last 20 years or last 10 years. You are going to have these 4 growth clubs. Bihar and Uttar Pradesh are a club of its own. So yes, first on Bihar and Uttar Pradesh, their growth is now, their growing average per capita growth is 5% or more, let's say. But still, given their level of income, they should be growing roughly double. So a lot of people are celebrating the higher growth, which we all should celebrate, but we should not be happy with that. We should expect more. Where Bengal comes in, Bengal is actually, fortunately, in the slightly better growth club. So their growth relative to their income is much higher than Bihar, still much worse than the higher growth clubs like the Maharashtra, etc. So that's why I focus on these two. And I think the fact that 1 in 4 Indians live in these 2 states means 1 in 25 people in the world live in these 2 states. I think is worthwhile just focusing and solving that first, and then everything else I think is secondary.
Thank you.
Can I come in for 15 seconds on
Sure.
Bihar and UP? Ruchir, very soon you'll have to put them into different brackets. It's happening already.
Yeah.
So we are doing some state level work at NCER and we are doing state diagnostics. So the 2 things that are very important. One is the fact that we miss out population growth rate. Bihar's population growth rate is very, very high. That takes away from whatever growth they do. And the second is drivers of growth and how they're managing their public finances, how they're managing their governance, and this, whether it's politics, whether it's something else. UP is looking like a state which will be a breakout state, and that will matter for India's prosperity. Bihar is looking like a basket case. So I think you may want to unbundle them sooner rather than later.
I think
Thank
if
you
you look
for
at Eastern
that.
UP separate from Western UP, so a lot of Eastern UP is behaving very much like Bihar. That's what I've shown from a district level. But
Okay.
Good. Yeah.
Let's go to the floor. Who wants to start? Gentleman there, will you announce your name, organization, and you want to put
Sure.
the question to one particular panelist?
Yeah, my name is Rajiv Agarwal. I run a fund called Dudarshi India Fund.
You see, Agarwals are everywhere.
Yeah. So my question actually is to Ruchir. You presented the fact that almost of the billion people, around 400 million people are unbanked. They don't have credit right now. It is very, to me, once credit becomes available, as you were saying, suddenly the livelihood of the person starts going and it can have a compounding impact. Why is it that our regulators, especially the central banks and the people who regulate, let's say, the NBFCs, which is what you are talking about, because they are the legs, as you are saying. So what exactly is the reason why we would not want to be much more aggressive in going out and sort of expanding the lending?
Let's take a couple of more questions so that we can manage time better. Yes, sir.
Thank you. I'm Rakesh Kaul.
Get a mic here, please. Thank you.
Thank you. Very stimulating. I'm Rakesh Kaul. Poonam started this panel session with the observation that the Indian exciting story began with reforms. Somehow the reform story is no longer being heard. Shouldn't we be doubling down on what kickstarted it? And if each one of you had one reform that you would wish the government to make happen, what would it be?
Okay, let's take one more. Yes, sir.
I'm just going to add to Mr. Agarwal's question on NBFCs. I'm noticing, Deepinder Bhatia, I'm the founder, partner of Bayer Asset Management based in Princeton. So the question here, just building on the NBFC question, most NBFCs have avoided coming under the banking supervision network when given a chance in the last 5 to 10 years, have chosen not to convert themselves to banks. In fact, we're seeing some banks creating their own NBFC, such as HDFC banks, HDB, and so on. Geo has come in as a separate player. I'm just curious to know, what's the regulatory impediment that is not encouraging them to actually enter into the banking network, as you described, and be able to take CASA cheap deposits, and how might that change? Thank you.
Okay, let's start with responses. Ruchir, you first, and ask other panelists to add.
So the first question was about NBFCs not expand. Yeah. So I think, yeah. So what has happened is after there were two big NBFC shocks. Okay, ILFS and Diwan Housing, and both these shocks truly shook the Indian economy. And so that really, in a way, the regulators, the RBI, was playing a bit catch up. Like in many other countries, they grew very fast, especially after demonetization. And so in about a year, they withdrew licenses, about 10,000 NBFCs. There are many, many small ones. And so here, there's a story of kind of throwing the baby with the bathwater, as they say it, where there is a lot of conservatism because they don't want that to happen again. And so they're being very careful and conservative. And so even as Anantha said, on the consumer lending side, a lot of new lending is happening, often coming from NBFCs using digital lending. But now our regulators are quite proactive to make sure to not have the same sins. But my worry is, and also as Poonam has said, that we may, if you take into account the growth cost of that, you may actually you may want to have a slightly more risk-taking than you are. And last, if I can take 10 seconds to answer the second one, basically think about giving a banking license is is something any country should not take very easily. And they are very serious about it, because once you have banking license, you can do many things. So the Indian authorities have been traditionally very conservative. And so they even blocked a merger in 2018 of an NBFC with a small bank, which later on then ended up having problems. So actually, it's not like any NBFC today can decide to become a bank. You have to meet a lot of, you have to really satisfy and convince the regulator. And so I think that's also the paper with Professor Panagaria and Poonam has on privatization of public banks. And I want, my own main comment to them was that should include this discussion on taking the NBFCs and also bringing them into the more commercial banking sector.
Would you like to add anything?
So I think on the banking licenses, I would say we can do better. We can do more. I think we are being extremely on the cautious side. That is one answer. I think in terms of converting some of the well-run NBFCs into banks and being able to accept deposits, I think after we allowed banking licenses on tap, we have probably issued just about 2 of them. I think there is case to be made that we can do better. That is one answer. But the other answer is about in terms of financial inclusion and the unbanked 400 million people, etc. Barely 8 years ago or 9 years ago, the number of Indians who had a bank account was very little. And in these 8 years, and according to BIS, India has covered the ground in 8 years, what other countries took 49 or 47 years to cover that ground in terms of financial inclusion. So the other things will follow. And in this, I would say, making haste somewhat more slowly is better, because we want the gap between 2 financial cycles in our country to lengthen, not become shorter. So stronger for longer in that sense is better, but that doesn't preclude faster banking licenses. So I would take both sides of the argument there. And as far as the question on what is the reform that I would be interested in seeing, I think much of the action now has to happen at the subnational governments level and deregulation. There was a brilliant piece of research by a young think tank called Prosperity, with the I in the end, prosperity.in. And the story about land regulations, the amount of space to be allotted for setbacks, parking, stairwells, and the floor space ratio. So I think the average amount of land that Indian businesses are unable to use is about 50% of the land they occupy. And in the case of micro enterprises, it's almost close to 100%. And even if we don't reach international standards, if we reach the standard of India's most liberal and progressive state with respect to land regulations, which is Haryana, by the way, and in those 10 states, if the rest of India can match up to Haryana itself, the amount of utilization of land space and therefore reduction in fixed cost and therefore the ability to expand employment is quite significant. That's just an illustration. So that is where I would like to see more action. Deregulation, deregulation, and deregulation.
Poonam?
So I'll take the one on reforms. I don't have a one-word answer for that, but what is needed, as Anantha said, reforms have to be now adopted and implemented by the states, because each state is at a very different level of development and their requirements are different. So how do you first own them, the reform narrative, and second, equip them to identify and implement those reforms? Having said that, agriculture is a sector. As I said, we are looking at different states. So we just ended looking at Orissa, a success story, right? But the main components of that success story is a whole lot of public revenues are spent in rural areas and on agriculture, a sector that is not taxed. So really taking public money, taxing urban areas in manufacturing and services and deploying those resources into agriculture. It's clearly unsustainable. So how do you reform your agriculture sector, consolidate land holdings, make it more productive, make it a sector which is not catering just to domestic demand? See, domestic demand for agriculture will not increase a whole lot. Population growth rate is slowing. There's only so much you can eat as you become prosperous. You have to now produce to export to the rest of the world. So agriculture sector is a big black box and a politically sensitive one. Urbanization and employability of people. A final one I'll add is FDI, howsoever you get it. So if you want to become the Vietnams and South Koreas of the world, you need to handle all of these issues, and better to handle them at the state level rather than expecting the center to do everything needed.
We are running out of time. Let's take one round of 3 questions, quick answers, and I'm looking at a very strict chairman. Is that a lady with a? Yes, please. You go first. Lady with her hand up, please.
Thank you. I'm Kalpana Kanthan with the American India Foundation. Hi, Ruchir. Hi, everyone. This was fascinating. I want to understand one thing as a non-expert, right? Our work, a lot of our work is in public health, education, and livelihoods for the poorer sections of India. And one thing that we've done in livelihoods is try to unlock loans that are available from the government for micro-entrepreneurs, street vendors, etc., like the PM Swanidhi scheme and, a lot of schemes like that. So in your analysis, when you talk about capital for those who are in the lower sections of society, have you accounted for ways in which we can unlock existing capital, sources available for people like street vendors who are an unorganized sector? And what can be done there so that those existing, avenues are being utilized and leveraged and used?
Next. Yes, the guy right at the back. Yes, your left hand is up.
Thank you.
Yes.
So my name is Juma Vatsa. I'm second year MPA student here in Columbia SIPA. 2 quick questions. One from Dr. Gupta. You mentioned FDI investment is softening in India right now. I'm just wondering, is it a temporary bump or it's some piece of larger pattern? And second question to Dr. Agarwal. You showed in your presentation that NBFC is 31 to 32% digital payment world. And so as it is growing so rapidly, what are the policy implications you see, and what government should do, what kind of guardrails should be put there? And on a lighter note, did you account for all kind of Agarwals? Because in India, there are so many Agarwals in your research. All. Thank you.
Last question. Yes, sir.
My name is Denny Devitri, and I'm wondering.
Devitris all come from Jamshedpur?
Yes, I'm from Jamshedpur.
Yes.
I'm wondering about our literacy rate in India, which is, I think, about 76%, with women at 65%. And you compare that to China, which is at about 98%. And is there a specific, well-planned idea of how to get our literacy rate, accelerate our literacy rate into the 90s?
Okay, this is the last round of responses. So I'm going to go back to the order in which we started. Poonam, you first, Dr. Nageswaran, and then Ruchir.
So I'll take the one on FDI, but before that, the second bar on the list of billionaires was Gupta, but they have been forgotten. It's only Agarwals we are talking about. On FDI, it's both a cyclical and a structural story. So currently, FDIs are slowing down around the world. India gets a certain percentage, so India's FDI have slowed down. But if you look at the long term, FDI inflows into India have not exceeded more than 2% of GDP. A comparable figure for Vietnam is 6%. So if you actually aspire, so India is good these days to translate its aspirations into quantitative targets, right? 5 trillion economy or something else. Why not a target for good FDI, rather than shying away from that? My narrative is FDI brings technology, finance, and access to markets. So whatever it takes to attract more FDI, it's both a structural and a cyclical story.
Dr. Nageswaran.
No, this is regarding the question on literacy. I think as a snapshot, what he said is correct. But as a story of the flow, the change, delta, I think India is catching up very quickly, especially with respect to women education, because in tertiary education, there used to be only about 76 women enrolling in higher education for every 100 men. But now the number in just the last 10 years has become 97 to 100. So I think I would consider some of these areas as actually fruits for further improvement in India's potential growth, rather than seeing them as handicaps or shortfall. Just very quickly on the FDI, if you look at the last 2-3 months of data, even for 23-24, India had caught up with the first 6 months of shortfall in FDI. I think the reason why the numbers look slightly unfavorable compared to previous year is the repatriation. But that's not a good indicator, because repatriation could be of any investment made any time in the past. It just so happens that it happens in this particular year. So it is the gross FDI flows, which in 23-24, by the time January came around, it had pretty much caught up with the 22-23 numbers. And also, UNCTAD, in terms of greenfield project announcements, India still remains on the top bracket there. So I think that story is a good one. And as Poonam said, there is some of it is a global decline, risk aversion. You get 5% in US Treasury, why bother? Right? That's also there. Yeah.
Ruchir?
Yes, I'll address 2 questions that were posed to me. So, Kalpanaji, I think I agree. I very much like what you're doing, which is basically help people connect to existing programs. And in a world of more difficult fiscal environment, I think that's really important. I think there should be ways that you can monetize your work and self-finance their work, because it's in the interest of the workers. If you're an employee, you help them get better pension benefit, or better social benefits. That actually is beneficial for the employee. So there are companies that are working with employers and getting paid by employers to help get their employees plugged in. And I think this is especially with a lot of the new programs that have come out, there's a lot of uncertainty. So it's great. On the NBFC policy side, I mean, there's a standard, banking regulation is standard, which is you minimize risk while trying to increase opportunity, good, healthy growth. So I think the more interesting thing is what's happening on the real side. So today you have new ways to give unsecured loans based on people who don't have a lot of credit history. So you're using cash collateral. Some companies are looking at your social media profiles. And so there's a lot of exciting work to be done in fintech and using big data, using machine learning tools to help us figure out who are truly honest people to lend to, while weeding out the bad actors. We are too afraid of the bad actors. And that's where we can use our economic skills, data science skills to do good. And last sentence for all, I think the conversation we've had today demonstrates the importance of the India's growth story, not just for India, but for the world, as India is becoming more and more the bigger contributor to global growth. And I really wish more of us can be part of this conversation. So thank you.
This brings us to the end of this session. Thank you for giving us this opportunity. I'm sorry I missed a lot of hands. It's partly due to my eyesight, but also because I was keeping my eye on the chairman, who wants me to be very strict. You're now going to have the India's rock star, Mr. N.K. Singh, coming up to chair the session. And I have mentioned him before. And Mr. Dinesh has walked in overnight from I don't know which part of the world. He's in different parts of the world every day. So second session is going to be very good. Thank you so much. Thank you to all my panelists. Thank you.